The quiet warning signs. How crises are engineered before they happen. Every financial collapse in history has followed the same eerie pattern, a pattern most people never notice until it's too late. Governments publicly claim everything is stable. Banks assure depositors that your money is safe. And financial experts appear on TV repeating the same scripted message. There is no reason to panic. But behind the scenes, warning signs begin flashing long before the freeze ever happens. It starts with liquidity shortages, banks tightening lending, quietly restricting large withdrawals, and slowing cross-border transfers. These subtle changes are the first signals that a system is losing blood. Then come the government indicators. Emergency meetings held late at night, central banks buying back toxic assets, and unusual increases in short-term borrowing. All of these are red flags that never make it onto the evening news. Next is the engineered narrative. Politicians begin using phrases like temporary measures, financial stability, or protecting national interests. These may sound harmless, but historically, they always appear right before a major financial lock-in. It's the pre-freeze script, the one every government uses when preparing to limit public access to their own savings. In the weeks before a freeze, banks start stress testing quietly. ATMs run out of cash more often. Transfer systems experience technical issues. Withdrawal limits appear on certain accounts. The public thinks it's random, but insiders know it's the tightening of the noose. And then it happens, usually on a Friday night or holiday weekend, when people are distracted. The government announces the freeze as a temporary stability measure, but once a banking system locks up, history shows it rarely returns to normal. The warning signs were always there, silent, subtle, and ignored until the doors slam shut. How digital banking makes freezes easier than ever in the past. Freezing a banking system required physical force, armed guards at bank doors, trucks blocking cash shipments, and government agents seizing vaults. But today, the world has shifted into a digital economy where money exists more as data than paper. And this new landscape gives governments a terrifying advantage. They can freeze an entire population's wealth with a single line of code. Most Americans don't realize how dependent they've become on digital rails. Over 90% of U.S. money already exists only as digits on a screen. When you swipe your card at Starbucks or transfer cash through Venmo, nothing physical moves. It's just permission, access granted or denied by centralized systems. And the moment a government declares an emergency, those permissions can disappear instantly. Digital banking also creates choke points. All major banks run through a small number of centralized networks: ACH, SWIFT, Fedwire, RTP. If any one of these rails is paused or intentionally shut down, millions of accounts automatically freeze. No cash withdrawals, no transfers, no payments, no escape. In a world without physical money, the freeze becomes invisible. Banks don't need to tell you your account is locked. Instead, your card simply declines. Your app says error. Your wire says pending review. To the government, this is the perfect control mechanism: silent, deniable, and instant. And then there's the ultimate tool: automatic transaction surveillance powered by AI. If the system flags unusual activity, it can auto-lock your funds without any human involvement. You don't need to commit a crime. You just need to trigger an algorithm. Digital banking has made our lives easier, but it has also made us vulnerable in a way no generation before us has ever been. The modern freeze requires no soldiers, no physical force, just a keystroke. Why governments freeze banks? The hidden playbook explained: bank freezes don't happen randomly. They're not accidents, glitches, or technical problems, even though that's often the excuse given to the public. When a government freezes bank accounts, it is almost always part of a deeper playbook that nations quietly rely on to maintain control during moments of crisis. The first reason is panic prevention. When an economy starts shaking, the average citizen does the most logical thing: they rush to withdraw their money. But banks don't hold your deposits in full, not even close. Under fractional reserve banking, a major U.S. bank might have only 2 to 5% of customer funds in actual liquid cash. If too many people show up at once, the entire system collapses. So instead of admitting this flaw, governments simply stop the panic by freezing withdrawals. The second reason is debt protection. When inflation rises, when bond markets shake, or when a currency is losing trust, governments need your money to stay inside the system. A freeze prevents capital flight, people moving their savings into safer assets like gold, crypto, or foreign banks. It's the economic equivalent of locking all the doors before anyone tries to escape. The third reason is compliance enforcement. Whether it's new taxes, emergency measures, sanctions, or political pressure, bank freezes give governments a quick way to force obedience without having to send police or file paperwork. If you don't comply, your money simply stops working. And the fourth reason, the one almost never discussed, is power consolidation. When governments freeze accounts, they reassert authority over the entire financial system. It's a reminder that your money is not really yours. It's leased to you by the state, and access can be removed whenever they decide the conditions require it. In every freeze, the truth is the same. It's not about protecting you. It's about protecting the system. The digital trap. How cashless systems make bank freezes unavoidable. A bank freeze is terrifying. But a digital freeze? That's total control. For decades, governments have slowly been pushing societies toward a cashless economy. One card, one phone, one tap. It's sold as convenience, innovation, modernization. But behind the sleek apps and contactless payments lies something far more powerful. A system where access to your own wealth can be shut off instantly, with no court order, no warning, and no escape. In the old world, even if banks were closed, people could still use cash to survive. Cash was freedom. Cash was privacy. Cash was power. But in a fully digital financial system, every dollar becomes traceable, stoppable, and programmable. You don't own money anymore. You rent it. And the landlord is the government. Digital payment networks like card processors, ACH transfers, and mobile wallets create a single point of failure. If a government declares a financial emergency, one switch can freeze an entire nation's ability to transact. No ATM withdrawals. No debit card purchases. No online payments. Nothing moves. This shift has already begun in the U.S. South banks close physical branches. Stores refuse cash. Tech giants process more payments than traditional banks. And central banks talk openly about CBDCs, central bank digital currencies, programmable money that can expire, be blocked, or be restricted to approved purchases. In such a system, a freeze doesn't just lock your savings, it locks your life. Your ability to buy food, pay rent, get gas, or travel can be turned off like a light switch. And here's the chilling part. A digital freeze is invisible. There is no dramatic bank run, no broken ATM, no lines outside branches. Everything simply stops working, quietly, instantly, and completely. The future isn't cashless. It's controlless. How to survive a freeze. Real strategies before it's too late. If a government-ordered bank freeze happened tomorrow, most people would panic. But the truth is this. Surviving it isn't about fear. It's about preparation. And the time to prepare is before the freeze, not after. The first rule is diversification. Not the Wall Street kind, the survival kind. Never keep all your money in one bank, one app, or one digital platform. If all your financial oxygen is in one place, then one freeze can suffocate your entire life. Split your funds across multiple institutions, ideally ones with different risk exposures. Second, maintain a cash buffer. In an emergency freeze, digital systems fail first. Cash still works, at least for a little while. Most Americans don't keep more than $100 at home. That's not a buffer, that's a snack. You need enough cash to survive days or even weeks of buying food, fuel, and essentials. Third, consider holding real assets, the kind that cannot be instantly frozen. Gold, silver, or other tangible stores of value. They're not investments, they're insurance. When the digital world locks up, the physical world opens up. Fourth, stay debt-light. During a freeze, lenders don't stop demanding payments, but your ability to pay may be disabled. Debt becomes a choke collar during instability. Finally, understand the mindset. In a freeze, those who stay calm survive. Those who rely on the government panic. Those who prepare early barely feel it. A bank FR. Ease isn't science fiction. It's a test, one you want to pass before it begins.